Hi APE Econ students, Mr. Muller here, and in today's video we're going to be talking about market outcomes and tax incidence. In the last couple of videos we talked about how the price of a good or service is determined, and ideally it's the intersection where demand and supply meet, where we have that equilibrium point. Now, in the last couple of videos when we looked at elasticity, we were trying to figure out how buyers and sellers will react to changes in prices. Well, there's something else that could happen that can alter the price of a good or service and not achieve equilibrium, and that's taxes. When the government, wherever it is, decides to put on a tax on a certain item or a good to get tax revenue, how does that change the patterns of buyers and sellers? That's what we're going to figure out today. Hope you're excited. I'm excited. Let's get started. So let's talk about a couple of terms here. The idea of welfare economics is a branch of economics that studies how the allocation of resources affects economic well-being. So what is the well-being of the people who buy goods and the people who sell goods? Ideally, you want both of them to be making some sort of surplus. Now, this is divided between consumer surplus and producer surplus, and that measures the values that a market, Amazon, a fabric souk, McDonald's makes. Now, how you determine a consumer surplus and a producer surplus, we're going to talk about in just a minute. First, let's talk about how we determine consumer surplus. First thing you have to do when we're looking at consumer surplus, which is the difference between the willingness to pay for a good and the price that is paid to get it. The willingness to pay is just the maximum price you will pay to get your lawn mowed or get your laundry done or buy a hamburger or buy that car. The idea is you want your maximum price to be much higher than the price you actually pay for a good. And that difference is the consumer surplus. So when a price is greater than your willingness to pay, you're obviously not going to buy it because it's over your maximum. But when you have a lower price than that, that creates that consumer surplus. So let's look at an example here. We got Beanie, we got Mitch, and we got Frank. And they're looking to buy college textbooks. A lot of you are going to be doing that soon, and they are ridiculously expensive. Try to get used ones online. That's how you can save a lot of money. You don't need the updated version, and some professors are jerks and want you to buy their book instead of a better book. Look, all right, I digress. So these guys all want to buy a textbook. Now, one thing to know is the willingness to pay for each individual is different. So Beanie's willingness to pay for a textbook is $200. Mitch's would be between anywhere up to $150, and Frank's is up to $100. Now notice, as the price goes down, the demand for those textbooks will go up. So if the price of the textbook is over $200, there is no consumer surplus. Whereas let's say it's at $150, well, Beanie has a consumer surplus of $50 because his willingness to pay is higher than the price he got it for, and so on. Let's talk about the other side of this, the idea of willingness to sell and producer surplus. Just like willingness to buy, willingness to sell is the minimum price that a seller will sell their product for. All right, this is what I will sell you that brownie for, or that hamburger, or that car, or my laundry service. This is the minimum price I'm going to take. And that's because of the costs that it is used to produce that particular good. Now, a producer surplus is the difference between their willingness to sell price and the price they actually sell it for. So whereas the consumer surplus is a price below their willingness to buy, for a producer, the producer surplus is a price above their willingness to sell. You might not want to write that down to get that in your head. Now, if we're looking at social welfare, which is the branch of economic welfare, that is determined by calculating total surplus, which is just taking producer surplus and consumer surplus and putting them together. And that will measure the well-being of all participants in a market, absent of government intervention. In a perfect world where nothing is taxed, that's how you determine social welfare, because you want both producers and consumers to have a surplus, or else consumers aren't going to buy and producers aren't going to sell. Now, what you want is an efficient surplus, and that's when the allocation of resources maximizes. So you have the most amount of total surplus you can. Now, how do you determine that? That's the point of equilibrium when we're looking at the price of a good or service in demand and supply. So when a market is efficient, you have the most surplus. And the goal of this is to provide equity. which we want to have as many benefits distributed among buyers and sellers. We don't want consumers to have more of a surplus than producers. We want there to be equality, so producers will produce more, consumers will keep buying. When you have that little playing field, everyone wins. So here is a producer surplus example. Again, we got Beanie, we got Mitch, and we got Frank. They want a tutor. Frank's minimum price is $10 or 10 JD. Mitch's is 20, and Beanie's is 30. Maybe Beanie's trying to tutor an AP Econ. He won't take anything less. Notice that the producer surplus, let's say if Frank is getting paid 30 JD and his minimum is 10 JD for an hour, man, he's making 20 JD in a producer surplus. He's doing pretty good. Whereas if Beanie, his minimum price is 30 JD or $30 or 30 euros and he only gets 30, well, he's probably not, he's going to tutor, but he doesn't really have much of a surplus. So he might not be motivated to continue tutoring. Now, if you look at this in a chart, this is what it looks like. We have our efficiency right here because we've maximized consumer and producer surplus, and we have equity because we have the same amount of surplus for both goods. We have an equal distribution between buyers and sellers here. Now, this is when the government does not interfere in these types of markets, but that's not realistic because every government taxes some things. Not everything, but they tax some things because a government needs to make money for itself. I don't want to get too much more into that because that's macro, but when a government decides to tax things, well, how does that influence the actions of buyers and sellers? Let's take a look. What we need to do is calculate something called deadweight loss, which is the amount of money that is leaving producers or consumers and going to the government. And we need to know how these taxes will affect the choices that consumers and producers make, because that will influence how much that product is bought and sold. Now, the taxes that get put on these individual goods are called excise taxes. And what you want to do is you have to figure out as a government who's going to get the incidence of taxation? Who's going to bear most of the burden from that tax? If I'm increasing the tax on apples by 5 JD or $5 or 5 euros, well, who's going to bear the burden of that extra tax, that extra dollar euro JDs? Is it going to be the people who buy those apples and I'm just going to raise the price by 5 euros JD dollars, or is it going to be the people who supply them? Now, when that happens, if the incidence of taxation is on buyers, it's going to shift the demand curve to the left. Sorry, I keep thinking I know you're opposite. It's going to shift it to the left because demand is going down. And if it's put on sellers, it's also going to shift to the left because it's going to hurt the supply of a particular good or service. Now, it's incidence of tax is independent on whether it's levied on the buyer or seller. Sometimes they're shared equally. Normally, in real-life situations, it's not all put on one particular group. It's shared so that you don't influence the amount of people who buy or sell that good too much. Now, if we're looking at the term for deadweight loss, the technical term, deadweight loss is the decrease in economic activity caused by market distortions. So how many fewer of those products are consumers going to buy or producers going to put out in the market? You don't want to be too drastic because then as a government, you're getting less taxable income. You want to maximize the taxable income you're getting on that good. So you don't want to put a ridiculous tax on it. Now, when we talk about elasticity and how this applies to taxes, especially excise taxes, are usually levied on inelastic goods, things that people really can't alter their buying patterns for too much because there's no substitutes, and in that case, there's very little deadweight loss. People really don't alter their patterns too much, but as we talked about in elasticity, if you keep doing that in the long run, people can change some of their actions, but it can be fairly minimal. And when that happens, the consumer gets the entire burden, not the company, because the consumer can't do anything. If taxes on electricity go up, you need electricity. You may alter some of your patterns, but you're still going to be buying electricity. When it's somewhat inelastic, like gas or things like that, the burden of taxation is shared because you don't want to put it all on consumers because they have some options. And when they're levied on an elastic good, it's the producer. So those are things like fruit or video games, things where people have a lot of choices. And the idea is you want to put the tax on the group that can bear it the best, the incidence of taxation. So let's talk about a particular example here. So originally the price would be $4 for milk, right? Let's say this is a fairly inelastic good, so the burden is placed on consumers, and so the demand curve shifts to the left. So now the equilibrium price is $3.50. So what you do to determine the deadweight loss is your quantity goes down from 1,000 to 750. What you do is you calculate this triangle, and that determines the deadweight loss that you have. Now, what you also have to look at here is who's bearing the burden of this change. And we're looking like this is a lot of the consumers are bearing the burden here. Let's look at some different examples. So this is a highly inelastic good. And when that occurs with a highly inelastic good, it's going to be put on the seller. So let's say sellers move up here. So the demand, the supply curve shifts to the left because the demand stays constant. And here's your tax revenue, because all you had to do was take the shift and find that rectangle. So here's how the tax revenue increases. So you take the first price into the second, and there's your revenue. If we're looking at something that is highly inelastic, fairly inelastic, not totally, but somewhat, you're going to have this burden more placed on consumers and producers. And so as you can see here, the supply curve is going to shift, but you see that that burden is shared between the consumers and the producers. So here's the tax money the government will make, and the deadweight loss, you just take after that new graph, you find the quantity that changed. There's your triangle. There's the deadweight loss. So that's the money that consumers or producers are losing out on. If we're looking at something that is highly elastic, so a really elastic good, supply is going to shift, and you note that the triangle, the deadweight loss is mostly on the producers. And just one little check I want to make. Okay, if we're looking at something that's highly inelastic, just note the supply curve has shifted, but the tax burden, the deadweight loss, is carried by the consumers, because that's where the triangle is going to be here. Because if you notice, the producer surplus doesn't change. Again, that's a little confusing. You may want to go back and rewatch that section again, but I'm just showing you how to figure out what's the tax revenue a government's getting and who's bearing the deadweight loss from these graphs. So you're going to have to know those situations because you're going to get asked questions on them. Now, when we're looking at deadweight loss to actually determine what those numbers are, you just basically have to look at from our third video on how to use graphs. You just find out what the area of a triangle is, which is half the base. It's the base times the height times a half. So you calculate base times height, and then you multiply it by 0.5, and that gives you the area of a triangle. Why do you then multiply by 0.5? Because it's half of a square. With a square, you just you multiply the base and the height. So for a triangle, you find the base and the height, and then you have it. Look, geometry was not my strongest suit, so you might need to rewatch that, but that's how you calculate the deadweight loss in these curves. So here's a question. What if the tax becomes high enough to really alter consumer or producer behavior? You're going to have some alterations, but you want it to be fairly minimal. Well, let's look at this graph here. So here's a situation where you have efficiency. There's no government interference. The government starts to get involved. So the burden here is being shared on the producers. But as the tax may go up, there's more and more deadweight loss. So people will buy that good less and less until the tax revenue isn't even worth that high of a tax. So the goal of a government, if you want to figure out that tax revenue, you just do base times height here. If you notice, at some point, you're losing tax revenue. So for a government, you can't put ridiculous taxes on things because you're not going to get the revenue that you want. Well, that's all we've got for this lesson on tax burdens and deadweight loss. Hope you learned something you didn't know before. When we're going to be in class, we're going to give you a lot of scenarios to determine who's bearing the burden of taxes and how to calculate what the government's getting and what's being lost. Hope you learned something you didn't know before. Thanks for watching.